morning. This is Jim Harvey, president of Opus 111 Group. And on this week's Your Money Week, I thought it would be useful and interesting to have my partners here at Opus 111 Group chime in on some of the developments that have everybody thinking about the market and their financial situation, based on current events. Let's face it, with wars going on over in, the Ukraine and inflation being a much bigger picture, the stock market volatility we've seen year to date with the market being down, lowered expectations for stock market returns moving forward. It really, and then increased volatility in the stock and bond markets. I mean, really, we're at a situation where I think it's good to hear from us, and we hope this is going to be interesting. So just to give you a sense of perspective here, the stock market year to date, last year the S&P was up 27%. Year to date, it's down 13.08% through last Friday. The NASDAQ is down 22% year to date. And the Dow, however, is only down 8%. And the reason is that value has started to outperform growth for the first time in more than a decade, since 2008. And we see those figures reflected in other ways of slicing that data. For example, the S&P 500 growth index is down 20%, but the S&P 500 value index is down 4.5%. The S&P mid-cap growth index is down 17%, and the S&P mid-cap value is down 7%. And then finally, small caps, the S&P small cap 600 is down 18% year to date, and the value is down roughly 8%. So we are seeing that rotation. We call it a rotation from growth to value. As a result, you've seen some massive declines in what we call the Mount Fang stocks, like Microsoft, but Amazon, Google, etc. In fact, Amazon has dropped from $3,600 a share to less than $2,200 a share in just the last few weeks. So we are seeing some of that. And so with that in mind, it really raises the question of how do we respond? And so I thought it would be useful for you to hear from my partners, who I get the benefit of working with every day. And first, I'm going to turn it over to Andrew, who's going to talk a little bit about this issue of market volatility and put it in perspective.
Well, Jim, I think I just kind of open with the broad statement that memories tend to be short, but history is a very long time. And volatility is not a new phenomenon. In fact, it's a pretty regular market force. I'll call your attention to this chart here. That's sort of a list of reasons why, there's always a good reason to not invest. You just take a look here. It dates back to 1970, and it's got any number of major events that, whether that caused market volatility or market volatility kicked up right around that time, right? First one back there is the invasion of Cambodia. They have Nixon's resignation, the fall of the Berlin Wall, Facebook being launched. Interestingly, I'm not sure how that one made it here, but Hurricane Katrina, of course, 9/11, and then most recently, right, the U.S. Capitol attack, the Russian invasion of Ukraine. Headlines which dominate the news cycle, because there's always 2 or 3 major leading stories going on at any given moment in time, can make it seem awfully scary out there. But if you look at the broad term trend of that line dating back to 1970, the outlook has been positive. Here's another way to visualize it, which is intra-year decline. So that's a market decline, peak to trough within a given calendar year, and then what the market wound up returning at the end of the year, right? You mentioned market finished, the S&P 500 was down about 14% as of last Friday. As of the date of this recording, it's down about 17% right now. I'll touch on that number in a moment. But this chart goes back to 1980. You'll see that of the 33 years that the market wound up, the S&P 500 wound up having a positive return on the year, the market was down at some point in all of them. So again, right, corrections, downturns are not a new phenomenon. They're actually really common. The average correction, right, peak to trough is about a 14% drawdown. Right now, like I said, date of this recording, we're at 17%. But in 13 of those years that the market wound up returning positively, there was a 17% or greater drawdown. So again, volatility spikes are not uncommon in this. And it's just important to remember that you are playing a game with a long time horizon. And just think back to that first chart where the line on the long term does go up. My last point would be for younger investors, right? These corrections and drawdowns can wind up being a pretty good entry point into the market, whether they've been overvalued or they see a short-term decline in prices. It can be appropriate to think of things as being on sale to a certain respect. So that's what I would have to say about volatility.
Well, thank you, Andrew. As a kind of a parallel to that, here's an interesting chart from our friends at First Trust about war times in the stock market for the S&P 500 going all the way back to 1928. And it literally shows every single war, major war, whatever, starting, with the Italian-Ethiopian War back, in the 30s, going all the way through today. And as you can see, as Andrew pointed out, does it have an effect? It may have a short-term effect, but the long-term trend line is pretty much low to the left and high to the right. So, all right. Well, so with that in mind, I thought I would turn it over to my my partner, Mike Maehl, who is going to talk a little bit about delving into the market data a little bit more, talking about growth and value and dividend payers. So, Mike, what can you share with us?
You remember that world-leading market analyst, Rod Stewart? Well, he had this one thing called every picture tells a story, don't it? I want to show you three charts in a row here from our friends at First Trust to kind of give you the, for instance, of how this difference in value and growth investing has been taking place. Now, they're all stocks, right? They don't come with a little sign on them that says, I'm value, I'm growth. And quite frankly, sometimes they can be both rather quickly. But it's two different styles. You got value stocks are basically trading below their value. The price is below what they're worth. And growth stocks, they've got above average revenue and earnings growth potential. And Jim showed you those, how would I say, underperformance charts rather nicely of what those growth stocks have been done. But, when you look at the S&P, because the Dow is only 30 stocks and it's primarily industrially oriented. So it's not really a good representative. So the S&P 500, when you look at that, it's not broken down into growth and value. It doesn't work that way. But there are two sectors that tend to kind of get the attention. The technology and consumer discretionary being online shopping and vacations, things like that. As we can see, those have been treated rather poorly here in the last 6-8 months. And right now, it doesn't look as if that's about to change anymore. But those two sectors make up 40% of the S&P. In the value, which is financials, industrials, energy, consumer staples, food, household goods, they make up about 29% of the index. So they don't have that much relative effect on what the index is. And when you look at the large value / large growth is back to where it was at the beginning of the pandemic. The small value, small growth is at its highest level since 2017. See, because these growth companies, they tend to focus on reinvesting earnings in themselves. They want to grow. You're not going to get a dividend out of these guys. Their entire thing is to improve their profitability, whether it's hiring people, expanding their market share, whatever it takes to do that. And they're based on their price to earnings ratio, price to book ratio, and that determines how, quote unquote, relatively expensive they are. Now, the values are the flip of that. They are the trade on their fundamental worth, and they have steady, predictable business models, kind of boring in some people's minds, but basically those are the blue chips. These are the dividend payers. They just consistently show up, send you a dividend, go up, a little bit every year, and perform a nice foundation for your portfolio. Now, there's no clear, I got to own growth, I got to own value. Nah, doesn't work like that. When economic conditions are good, as we've seen, growth stocks did pretty dang good. Now, in the more difficult periods, when growth isn't as obvious, now value stocks tend to step up, and that's what we're seeing take place in the market right now. And there's no reason why you can't have both. Well, I think you should have both, throughout your portfolio. The fact that some go up and some go down, there's the old adage that says, you can tell you're diversified if something you own you wish you never saw in your life. So it's like that kind of investing portfolio. You kind of round out the thing. So this is, again, another segment of the market. In my opinion, we are still in a secular bull market. You have these kinds of corrections, I don't care, whatever you call it, down markets. As usual and normal, going back to what Andrew said, all this stuff is, believe it or not, it has happened before. And so you have to maintain your steely-eyed look at the markets and say, yeah, that's too bad, but I'm going to stay with it, and because I do what we do, and we're going to take care of our clients in that regard. So that's it from here, James.
For our clients listening in, they've heard us talk about trimming their Mount Fang stocks. Those are the, Microsoft, Apple, Google, Amazon, etc. over the last few months and actually, last year or two. And we've seen, that pan out. I mean, interesting data through April. Dividend payers posted a total return of -5% versus almost -11% for non-dividend payers among the S&P 500. And those dividend paying stocks are the ones you're talking about, Mike, the large cap value names. And we call it a flight to value because when people are freaking out and, oh my gosh, people think, oh my gosh, Amazon's terrible now. And it's dropped from 3,600 to 2,200. Where do they put money? Well, in Heinz and in General Mills and in IBM, these big companies that pay dividends because they like the return on the dividends. So thanks a lot, Mike. That's very helpful.
Sure.
So one of the other things that we are lucky to have in our group is our friend Bill Driver, who has been in the business like Mike almost 50 years. And was a wholesaler for an annuity company for 20 of those 50 years, and is our sort of in-house expert on annuities. And Bill, I thought maybe it would be useful to have you share some thoughts about investors' decision-making over the last couple, 3 years in the wake of this heightened volatility and that kind of thing. And in particular with respect to annuities and their role.
Yeah, Jim, I think, and I do think they have a role in this whole thing. And let me throw some numbers at you. And these came yesterday, as a matter of fact, from LIMRA, the LIMRA Secure Retirement Institute. And there's a mouthful for you. And this is really a worldwide insurance research group, and they track the sales of life insurance and annuities worldwide. During the first quarter of this year, just in the United States, though, annuity sales totaled $63.6 billion. Okay, big number, $63.6 billion. That's 4% better than the first quarter of 2021. Okay, and I think there's some reasons for that. I'll come back to that in a minute, but breaking that down, if you look at different types of annuities, variable annuities made up 19.1 billion of those sales, and actually we're down a little bit. And I think there's good reason for that because of the term variable. People are typically in a market like this, maybe a little less interested in the variable part of variable annuities. Registered index linked annuities, RILAs, as we call them, or structured annuities, another name, were up 4% for the quarter, or $9.3 billion. And then we come to the one that all the pundits love to hate, and that's the fixed annuity, right? The fixed annuity is the one where you give the insurance company your money, they guarantee you won't lose it, and it'll give it back to you in a couple years, 3, 4, 5, 7, depending on the terms of the contract, and some interest. Okay. Fixed annuities in the first quarter of this year were up 14%, $35.2 billion. So there are a lot of people out there that kind of like that whole safety idea. Okay. And you ask yourself, I guess, the question why, and I kind of already said it, I guess, but I think it's fear. And it's fear of volatility, as all of you guys have kind of alluded to at this point, volatility in the market, right? Annuities can offer you some downside protection, okay, of partial or full downside protection with some limited upside potential, right? And there are folks that, and a lot of them, who are willing to give up some of that upside if you can tell me I'm not going to go down as big as the market. I think the other thing that plays into all of this are rising interest rates, because guaranteed interest payments are now more attractive than they were. We talked about it yesterday at lunch, Jim. I got another piece here on my desk this morning about guaranteed minimum withdrawal benefits on the variable annuities, and how the interest rates at the payout points at various ages are increasing. They're up 25 basis points. They're up 50 in some cases. In other words, a quarter or 0.5%. Okay. So, that's kind of interesting. You look at fixed annuities, they're offering downside protection. Again, fixed annuities, no downside, right? You can't lose your money. If you give them your money, and I just looked this up this morning for one of the companies that we know pretty well, if you'll give them your money for 3 years, they'll give you 3.2% a year for the next 3 years, tax deferred. Okay. So if that's good enough, okay, maybe not, but it is, it is safe. I think that if you draw conclusions out of all of this, the conclusions are that annuities are the safe haven for investors in volatile times like we have right now. Okay? They'll go to them. They do go to them. Okay? Is it, as you asked me this morning, Jim, is that logical or is that rational? And the answer is yeah, because they feel better about it. So then it's logical, right? Is it correct to make the move now? All depends on what you're looking to do. If it depends on the kind of money it is, it depends on how you feel about risk and the market and your risk tolerance level. Annuities can be a piece of it. In my own opinion, I hope it's not all of it. But I think that's the story with annuities. It's the safe haven.
It occurs to me that, when we say, okay, well, annuities have a role, it depends. If you're dealing with, clients Andrew's age, maybe not, because they have a lot of time to make up and they can play the long game. If you're 3 to 5 years away from retirement, the prospect of losing a big chunk of your 401k plan assets within 3 to 5 years of retiring is a much bigger thing. So it really does make a difference. If
you are in retirement and taking withdrawals, if you see, that portfolio is going down every year and you're taking 3, 4, 5% out of the portfolio, you're adding to the down market. So market's down 17, you take out 5, you're down 22. I mean, that sequence of returns risk can be significant as well.
We've designed portfolios for you, if you're one of our clients, to be as resilient as possible. As Mike was saying, you don't want to just have growth, you want to have both. You have growth and value, you want to have international and domestic, you want to have commodities, etc. We have a plan for your portfolio to try to design it to minimize, can't eliminate, but minimize fluctuations in the overall value of the portfolio. With that in mind, then when the market delivers opportunities, because things are on sale, then you look at what you own, you look at what's cheap, and you go, maybe it makes sense to shift, maybe it doesn't. Maybe it makes sense to move money into a product that gives you some downside protection, like a RILA or variable annuities, et cetera, or maybe you don't. But that's why people like us exist, and that's why our clients work with us, is to help them make that decision. Look, let's face it. Interest rates are going up. The Fed has talked about increasing rates another 50 basis points this year. That sounds like a lot, and it is based on where current rates are. Historically, however, it's not. When I got into the biz with Mike Maehl as my boss up in Anchorage in 1983, interest rates were a lot higher. Mike, you probably remember we were buying 16% 30-year Treasury bonds, 10% 10-year Treasury bonds, and I think 14% municipal bonds. And I think one thing that you should pay attention to, the Fed hikes are not unimportant, but they really affect the short-term part of the market, of the fixed income market. The big thing to keep an eye on over the next few months and years is the Fed unwinding its $9 trillion balance sheet, because what they're doing there is they're taking the other side of the trade to minimize interest rate fluctuations. And at this point, they have to unwind that balance sheet. So I think the message here is very clear. We're going to have increased volatility in the stock market. We're going to have a rotation from growth to value. We're already seeing it. We're going to have questions about the strength of the dollar. Inflation is going to be much more of a factor, and interest rates are going higher. So how do you position that? Well, we're looking at things that we think do well, various kinds of real estate programs, making sure you have exposure to managed futures and commodities, making sure that you've looked at all the different vehicles out there, including some variable annuities that work well, making sure in Mike's area that you have dividend paying stocks as well as the large cap growth names that have done so well over the last few years. So with that, if anybody else has any other things to share, that'd be great. But if not, thank you for your attention. If you are interested in learning more about our firm and also getting exposure to these kinds of written video and audio blogs and podcasts, we encourage you to go to our website, which is opus111group.com. In particular, go to the Learn page and you'll see our resources that are there for not only our clients' disposal, but for the general public as well. So thanks, guys, for your time this morning, and cheers. And the market will, in fact, fluctuate, as Bernard Baruch famously once said. So, all right. Thanks, everybody.